freaking amazing. For example, the IRS says that this house is going to wear out. All right? It's like the ship of Theseus, right? At some point, every piece of that house is going to wear out. At some point, you're going to need a new roof. At some point, you're going to need a new garage door. At some point, you're going to need to get in behind the brick and replace it. Now, what the IRS says is we're going to say the whole house is going to wear out in 27.5 years. So every 27.5 years, you can write off the entire value of your property. So every year, you can write off 1/27.5 of the value of the depreciable amount. Now, that's important because what the IRS is going to say is, hey, you bought the property for $207,000. We know that it's all going to wear out, that it's all going to get replaced. You're going to end up buying a new water heater, buying a new garage door opener, buying a new garage door, redoing the brick, redoing the siding, redoing the roof, redoing the cladding, whatever the crap, right? Eventually, all of it must go. Except the land. Land doesn't depreciate. That's a very, very important understanding. Land doesn't depreciate. So they won't let you write off the full $207,000. What they're going to say is, hey, you can write off 80%. You can write off the house, and we'll assume 20% is the land. That's what my CPA told me. So my depreciable amount equals $165,600, 80% of my purchase price. Right? And so what we do from that is we say we're going to multiply that or divide that by 27.5 so that we can divide it into little chunks, 27.5 chunks. And as we divide that out by 27.5, what it's going to say is we can write off, no questions asked, against this asset, $6,000 a year. Now, if you know anything about taxes and taxation, you will realize that a $6,000 deduction only saves you $6,000 times your tax rate, all right? If you're at a 50% tax rate because you're earning good money and that's what you're taxed on the progressive tax table, well, then that's going to save you $3,000. If you're at the 25% tax rate, then that is going to save you $1,500. Now, the nice thing is, $1,500 worth of value that I did not have divided into $54,000 worth of investment means just the tax savings is about 2.79%, almost 3%, just in the tax savings. That's freaking amazing. I did better than a CD to bank just on the tax savings.